Well, good day, everyone, and welcome to the MRI webinar. We've been conducting webinars throughout the day and demos for firms and advisors, and we're really excited that you're with us today. My name is Dr. Charles Chaffin, a co-founder of MRI, along with my business partner and co-founder of MRI, Dr. John Grable. So, who are we? Well, there's two of us. The third partner in this crew of co-founders is Dr. Brad Klontz. We work, Brad and I work in the financial psychology space. So we have a number of programs. We've had thousands of advisors go through our psychology of financial planning specialist programs, as well as custom programs that we offer for firms. And we're now in 15 different countries. And we work with over 100 colleges and universities to offer that program. And we've been doing that for about 2 years, and it's been exciting to develop our books and our programs and really help the profession in general, regardless of business model, understand client biases, behaviors, and perceptions. Dr. Grable, on the other hand, is the foremost expert in risk. He is the guy, and it's been exciting working with him and integrating both of those components into building MRI, which we think is transformational and revolutionary uh, for the profession. John.
Yeah, and so I think what brought the three of us together is trying to help advisors, firms, and advisors kind of walk through and work through the challenges associated with wealth management. So we already know that on the client retention side, that many advisors end up losing their clients. And this market environment is a perfect example of where there's really a stress on the client side, and the advisor is sometimes left wondering what happened. Why isn't the client acting in the way they told me they would act? What's going on? And so we got together to really think about comfort with risk, client psychology, blending those together to come up with a tool or a set of tools. I guess, Charles, we're basically calling it a suite of tools to
Yes,
help
sweet.
advisors anticipate and manage client emotions related to market volatility and economic uncertainty. And we've tried to do this all within a regulatory complexity environment. So the tools that we've created work on the regulatory side as well as just the pure practice management side. And so we're really focused in on trying to help advisors figure out what's driving their clients' behavior. And we're going to kind of walk through the tools and the models that we've created and give you some examples of what that looks like.
So we have a suite of products, as John said, that focus on really firms from prospect to existing and even long-term clients, right? So our MRI core is a comprehensive, it's the full-blown comprehensive risk and financial psychology component, gets into everything that's the 360-degree view of what a client, the biases, behaviors, and perceptions of a client, as well as the risk side. We developed Genesis with the idea that basically, how can firms convert prospects into clients? We all know that attrition rate from that initial meeting is really, really low. Well, why is the client not taking action on their plan? Why have they ghosted their advisor and whatnot? And so using financial psychology and risk, we're able to provide insights to the advisor on that specific client to help them engage that client and turn them from a prospect to a client. We developed Essential with the idea that it is a basically for existing clients that may not want to do a full blown version of understanding something like how they want, like we ask how they want to communicate. We'll talk about that in a second. Well, you don't want to ask an existing client that you've had for a long period of time. So Essential is basically what it is from the risk side and the financial psychology side that an advisor needs to know. Secura gets into this element of looking at different types of products, specifically like fixed annuities. How can we basically use risk and financial psychology to determine how prone a client may be to taking on something like a fixed annuity, or even going more beyond that, even looking at other products that a client may be well suited for. And then diving into working with banks or looking at, how can we better understand and communicate with our um, existing clients, our existing customers to turn them into wealth management clients? Why are they heavy on cash, for example, and not investing? And what can we do to kind of help engage that, engage them a little bit better?
Yeah, and so a fundamental element of all of those products or tools, whatever you want to call them, is something that we call comfort with risk. And you can think of this as risk tolerance, risk preference, whatever you're using in your current practice. Comfort with risk would be our model that matches that. And so I think what makes our comfort with risk score different than maybe anything else that's in the marketplace is that we start with an assessment of every client's willingness to take risk. So it's basically what you're using right now in your practice. You're asking questions to determine what's that maximum threshold of risk a client is willing to take. Okay, so we're going to believe the client regardless of what they tell us. We'll talk about that in a second. But what makes MRI different is that we calibrate that risk score against what the client has done in the past. So we look at what they did in practice, and we calibrate what they told us they would do with what they've done in the past. The second calibration is we look at that risk score and we compare that to the client's ability to take risk. So if everything aligns, so their risk tolerance, their willingness to take risk aligns with their past experience, their past behavior, and their ability to take risk, you can be very confident that what you generated from the score is likely what they're going to do in the future. If there's miscalibration, the system reports that back to you as the advisor. This doesn't go to the client. It's going back to you as the advisor, kind of with some red or yellow flags saying, be a little bit cautious here if there's a misalignment between what they told us they're going to do and what they've done in the past or their ability to take risk. And again, the MRI comfort with risk is embedded in all of the products, all of the tools that we've developed. So that's a core fundamental element of everything that you're going to see with the MRI.
So as we continue on here, we have, with our last session, I think we pulled up a different deck. I'm switching out decks here. There we go.
It seemed
So
to be the same there. Yeah, that's right. Okay.
there we go. Okay, I think we get. So go ahead. Sorry, John. Go ahead.
No, it's fine. So essentially, what is it you're going to get? So the client is going to, and we'll show you a really quick example in a few minutes of what the client actually completes. The report comes back to you as the advisor, or it comes back to the firm level. You could certainly share this with a client, but it's not an automatic thing that they're going to receive. So what you're seeing on the screen is really what an advisor would get back from MRI. So in this case, the score is 53. What does that mean? It just means on a scale of 5 to 95, with higher numbers being more risky, lower numbers being more risk averse, this person's probably right in the middle. So with that, we've taken great care to what I call map the risk score to very specific feedback for the advisor. So in this case, what does a score of 53 mean? The typing here might be a little small, but basically that aligns to or maps to a moderate growth portfolio. At that point, even more feedback is provided to the advisor in terms of the general proportion that would be in fixed income versus equities versus cash, a little bit about the tendencies of somebody who has a score of 53, and things to think about when you're working with this kind of a client. So if you look at that last bullet point, here's what it says. It's important to monitor your client's reactions to movements in the market. Implementing a deliberate and cautious investment approach may help the client reduce worries and avoid selling into a market downturn. So, that kind of feedback was written long before the market volatility that we're experiencing right now. But we find that these kind of reminders back to the advisor can prepare the client before the market volatility occurs. Number two, why we really love the MRI scoring system is that it's very predictive of actual client behavior. So if you're watching this and you are experiencing clients who are doing things that you wouldn't have recommended, so they're selling into a severe bear market, or they are reacting negatively to volatility, and you're kind of scratching your head, you're saying, well, I did all of these assessments, all of these tools that I've used for years, but they were not predictive of what the client actually is doing right now. That's an indication that the tools that you may be using, particularly in terms of risk tolerance, may not be as effective or as valid as you think they are. We're very confident that our model is very predictive of future client behavior. So, with a score of 53, in this case, and the feedback given to the advisor, developing a portfolio is going to be not easier, but it's going to be the pathway towards that development is going to be easier. Number two, managing client expectations along the way, I think, is enhanced by the feedback that the advisor receives. So, with that, that's sort of the comfort with risk. Charles, let's kind of jump in to the actual products and the other side of the MRI.
Yeah, so thanks, John. Our approach all along has been that we knew that we could do the risk side, what John talked about, better than anything that's been on the market. And at the same time, we see the opportunity on the financial psychology side for it to be that advisor's assistant, to provide insights on each client to help them develop a deeper relationship with the client, higher wallet share, retention, and whatnot. And so all of the elements that are part of the financial psychology side of MRI are a part of all of the books and programs that we've written on. So the psychology of money, understanding how individuals perceive money based upon their past, based upon whether them or their family have been victims of fraud, or if they have certain biases that come from growing up poor or even growing up wealthy. Are they more susceptible to financial enablement? Or are they more susceptible to fraud or whatnot? Or even that they may or may not trust an advisor more or less because, for example, they came from modest means, and maybe they growing up they found that, we're told that rich people were deceitful in some way, shape, or form, which leads to all kinds of other possibilities that the advisor needs to think about and having that deeper relationship. So we get into elements of counseling and communication. Again, as you're going to see it when we walk through the report, as being that assistant to the advisor. Think about this based upon this client. Consider this. And I want to mention, and we'll reiterate it again during this hour, is that we wrote all of this with the idea that the client is also going to see this report. So there's nothing in there that's going to A, undermine the advisor, or B, make the client feel ashamed of their path to some of these points that I just mentioned. We get into the attitudes, values, and biases. So, advisors always talk about behavioral finance. They equate financial psychology as behavioral finance, when in reality, it's just a small piece of it, but it's an important piece. So, is the client overconfident? Do they, if they answer that they know that they know where the market's going? Yeah. Well, we know that they don't. This week's a great example of that. So, understanding that you have an overconfident client can be immensely helpful, for example. Learning style, communication preference is all really important in terms of how does the client want to be communicated with? What method do they want to be communicated with? How often do they want to be communicated with when there's volatility? Should this be one of the priority clients to talk off the ledge when we have a week like we've had this week. Learning style is important because are they more visual? Making these tough decisions or adopting a plan, are you as an advisor going to need to present things more visually, or are they more kinesthetic? Are they going to want to write? Or are they arguing with you a lot, but they're more social learners and they just want to verbalize those things and whatnot. And then obviously thinking about one of the most critical components that's in here is readiness to take action, which we are really excited. It's another secret sauce for us, and that is we can determine based upon how we've developed this program if a client is ready to take action right now or they're thinking about it within 6 months, which is really helpful because, as you all know, if you push too hard on someone, on a client that's not ready to take action immediately, that's when they ghost you. So you know when to move forward and whatnot. So we're going to walk through an actual report here in a few minutes. But what I want to say about it is we developed this with a use case that an advisor would look at this 90 seconds before a client meeting. And it would be done so that if somebody read this and didn't know who created MRI, that they would never think that three academics wrote it. That it's easy to read and you can go through quickly and figure out, okay, where are the points that are issues that I need to think about? And issues in a sense that these may be priority items, not good or bad, but just that they're priority items for the advisor to think about. So, for example, looking at this one, you see behavioral finance as a red. So thinking about overconfidence, as I talked about earlier, it draws the advisor's attention to specific points. It's easy to read. It's relevant. We're not adding terms here and going on for 8 pages on, paragraphs about theory. This is about this client and the 90-second use case for the advisor. It's actionable. So what? What does this mean for this particular client based upon their MRI? And then accessible in terms of how it's easy to read quickly, but it's also accessible to the client. The advisor's never going to feel ashamed to share this with the client because it's not going to undermine them or make them feel bad about their report and whatnot.
Can I ask a question?
Sure, go ahead.
Okay. I don't mean to interrupt. I'm just
That's
curious. So
okay.
do you see this being a one time at the start of the relationship, or is it something that you would revisit periodically, or if their life changes, maybe they have children and their risk changes? Like, how do you view that?
I'm gonna defer to John on that because there's a big risk component to that. So go ahead, John.
Yeah, I think there's multiple answers to that question. Depending on the platform, depending on the advisor, and you'll see more of the example, but let's start with the core product here. This has all of those items, all of those questions. You could present this to the client or the prospective client right up front. Given the flexibility in the MRI system, you could actually parcel these questions out over over a period of time.
Okay.
You could also then follow up every 6 months, every year, or during periods of market volatility, come up and say, okay, I want you to readdress these particular items. So, Charles, go back one really quick, one slide. So, the color coding, I think, is really kind of fun and interesting. So, as an advisor, if I see something in red, I know that's something I need to probably address like immediately. The items in yellow are things definitely to put on the radar that I'm going to have to address. And what's not on here, we also have a green arrow, which is like, you don't even need to really worry about it right now. Just be aware of it. It's not a concern. As I go through time, if the client does have children, or maybe they lose their job, or they transition to a new job, whatever it may be, having them retake at least elements of MRI could be very valuable. And then you could do a comparison. Oh,
Mhm.
this is where we started. This is where they're at now. Now,
Got
in
it.
terms of comfort with risk, now you're into the realm of theory. So, which I actually love. Charles always says, don't talk theory. my hope is that the core comfort with risk score, you should not be seeing it fluctuate dramatically, even if a client had a child or they went through a divorce or they changed jobs. You're going to definitely see some variability, which you're seeing in the markets right now. As downward volatility increases, clients are retrenching a bit, in some cases quite a bit. But if you looked at their comfort with risk score, the hope is you're not going to be seeing lots of variability in those scores across time. If whatever product you're using right now, so you're using some sort of a risk assessment, as you go back and reevaluate clients and you do see large swings, I'm kind of way off script here, that would indicate to me it's not so much the client as it is whatever tool you're using to measure the client's risk tolerance. And so basically, yes, reassess them as much and as often as you want, but hopefully you're going to get that initial good picture of that person right from the initial assessment.
And
Got it.
I think too, which is another one of the other reasons why we walk through these products here. That essential piece is for a lot of firms, they're seeing that as the one that they would regularly give out, because what you don't want to do obviously is asking the same question over and over again. It's like, well, does this advisor even know me, right? Well, the client's going to say that. And also, John, bring up the point of parsing out questions. We've had several firms talk about that with us. The idea of during every period of time answering a few questions. So there's a lot of different ways to go at that. We kind of walk through the core. As John alluded to, it's kind of the full blown version of MRI. The Genesis system is basically, it's built upon that, so it has the risk component. But again, we're really thinking about this idea of a prospective client, getting them to be a client, right? So there's actionable feedback that's going to help that advisor through communication and whatnot. That's going to get them into an engagement. And also the other thing that has come up a lot as we've demoed this and talked with firms is maximizing the time that it takes to, whether it's on the risk assessment side or on even on the MRI side, that there's an ROI for doing it, that it's an important thing to do, and it's not going to be this long process that is going to take a client hours to complete, but it's really a great investment in taking the short time to take this Genesis system. Did you want to add anything more to the Genesis, John?
Yeah, I think when I look at the product lineup, Genesis is extremely good at taking a prospective client and converting them into an actual client. And how it does that is most of the questions are exactly the same. So the prospect is answering the same questions, but the feedback that the advisor gets is totally focused on how the client or the prospective client answered the questions. So if somebody did say, for instance, I or somebody in my family has experienced financial trauma, or I was ripped off financially, that's going to come back as a red arrow to the advisor. But beyond that, Genesis is going to give you very specific questions to ask the client. It's going to give you very specific strategies to work with the client on that particular issue. And this is really, for me, again, I'm off script here. We don't have a script, but I'm way off script. If you're having clients in today's market who are acting irrationally, it may not have anything to do with their comfort with risk. It could have everything to do with some psychological trigger that you're totally unaware of that's causing the client extreme levels of stress or panic. And MRI, particularly Genesis, is designed to identify those triggers before they actually happen so you can anticipate them and have the tools to actually help that prospective client address those triggers. And when the moment you do that, you're creating that trusting client advisor relationship that then links them. You're like their most trusted advisor going forward because you actually understood them, because you knew the triggers that were stressing them out. So probably a little too much, but that's why I love Genesis.
There's nothing like it in the market. We're really excited about it, and we think that it's going to add tremendous value in turning those prospects into clients. Essential is kind of what we talked about, right? Essential is kind of the pared down version for existing clients. But there are things that we know that MRI Essential in this case can uncover that your engagement with your existing clients won't. And it's just an opportunity in the feedback to see here's something to focus on in your next conversation, which opens up not only either identifying a new hurdle to them meeting their goals or a new opportunity for you to strengthen the relationship in whatever way that might be. Given all of you have probably hundreds of clients in some cases, so this could just help you identify some things that you otherwise haven't talked about with your existing clients. John, you want to talk about secure?
Well, can you go back one really quick?
Wait, did I miss something? Did I miss
No,
something in
no, you didn't
Essential?
miss anything.
All right.
Um, what I the unique feature about Essential and also about Genesis, but Essential for me is this. So if I came into, let's say I was your client and you actually knew that I had a high fear of missing out. You go, man, every time I meet with Grable, he's always worried about missing out on the next big investment. He's always worried about what his neighbors are doing. So you know that. I mean, you intuitively pick that up. The question I have as an advisor is, so what? I know Grable has FOMO, but what do I do with it? What strategies, what techniques, what tools do I use to help Grable work through his FOMO or to take advantage of his FOMO? And that's what Essential is doing. It's not just telling you, hey, Grable has FOMO or a high level of FOMO. It's saying, and here's what you can do to help Grable work through that situation or to enhance that trait or characteristic. So that to me is the fun part about Essential. If I'm an advisor, and I was an advisor many, many years ago, had I had a tool like this, I probably would not be an academic today. I'd probably still be doing financial advising because this is the tool that would have cemented my work with the clients. I would have known more about them than they probably knew about themselves, but not in a manipulative way, but in a way that would help them develop their strengths and be better clients, be better investors. MRI secure. So on occasion, we will be approached by firms that are looking for a very specific kind of product that's built off of MRI. And MRI secure is one of these that kind of evolved from some client requests. And in this particular case, it is matching a client's comfort with risk score with their portfolio score. So we have the ability to look at the asset allocation of a client and attach a score to that. And that score essentially matches their comfort with risk score. So you can imagine if you are on the annuity side or the insurance side, a client comes in and let's just say their comfort with risk score is a 40. But when you look at their portfolio, they're working with an advisor who doesn't know the client particularly well, and they've allocated the portfolio so that the portfolio score is a 60. In other words, there's a total misalignment between comfort with risk and actual portfolio. The annuity product or the MRI secure product helps an advisor sort of in a think tank way or a sandbox to go in and adjust the client's asset allocation to bring it more closely in alignment with their comfort with risk. And in this particular issue, it's how does adding fixed income, particularly fixed annuities or an annuity product, how does that dampen the level of risk in a client's portfolio to align more closely with a comfort with risk score? So again, secure exists, but I think what excites me here is if you're listening to this and you're going, we only work in cryptocurrencies. I don't know a firm that does that, but and you really need a product that deals with comfort with risk, also the psychology element, but related to a specific product or products. We might be able to help you with that.
And that's been the interesting thing. I mean, we you know not a we started with MRI core. That was our
Yeah.
vision, and then suddenly the market's telling us, well, yeah, we want this and this and this. Most of the products you're seeing here is because it was about some stage of where the client is in the relationship, and then suddenly it became, well, we think MRI can help us with this and this and this, and so we're talking with a lot of different firms about customization of MRI, as John alluded to, based upon some of these other pieces. We even got an inquiry about MRI for sports betting, but we'll leave that for another time. Uh, and did you want to add anything else here, John?
No, I'm good. Good.
Okay. And then, uh, as I talked about earlier, MRI wealth readiness is really an opportunity, particularly on the banking side. And again, this came from the market. Was basically helping banks and credit unions assess customers' openness to working with an advisor. And in a lot of cases, banks are talking about customers who are flush with cash, but they're not investing. And so, same approach that we take with all of our other products as far as risk, as well as their financial psychology, and then developing insights to help the bank, in this case, how to engage their customers based upon their risk and financial psychology. So let's just walk through the MRI here. I've done pretty well today in sharing. We'll see if I can do it seamlessly here, John. So when you take the MRI, this is MRI Essential, and so
but you're not doing it well. You need to stop sharing and
oh,
share
oh
your other screen. See,
I got cocky and I thought
you
that I was going
edge,
to get this. There we go. How
living
about
on the
now?
edge. I can see it.
Excellent. Okay, so here we are, everyone. This is what you get when you take it.
So this is
And
what a client would. This is what a client would see. So
thank you,
you would
John.
send this link or some mechanism. The client is actually seeing this. You as the advisor, you can look in, but this is what a client is filling out.
Thank you, John. That's right. And so so the client gets this, and this is our demo version I should share. And then basically, as we go through here, and I'm not going to walk through the entire thing. John's going to walk through the feedback, but put their name, put their email and the date,
By
and
the
then
way, if you're doing this as a demo for the first time, put in your email. We're not going to scam you or do anything, but that email is what sends the report back to you. So if you don't put in your email, we have no way of sending you a report.
that's
That's
right.
as you're doing a demo. Yeah.
Yeah, we've had firms say that. So, well, we love your test, we love what you're doing, but why isn't there a report? Well, they didn't put their email. So basically, this is like uh, any other assessment. You go through and finish this, and then obviously, and then the report is emailed. So, John, I'm going to go ahead and let you share.
Yeah. So at this point, what happens is the client has filled out the MRI. The moment they submit it, that goes back to the system, and then you are notified as the client's advisor. You get this report. You could share this with your client. There's nothing in there that would be derogatory towards the client, but that's your choice whether you want to share it with the client. And so what you're seeing here is a purely a demo. So what would happen is your company's name or advisor's name, whatever it would be here. Um, your logo, mascot, whatever you want to put in here is totally adaptable. By the way, I created that really cool logo with chat GBT. So, but you will put in anything that you want in there. So in this case, this is the essential report. So this is an existing client. So you're already working with them. And maybe this is a follow-up survey that you've done. Maybe it's a yearly survey, whatever it may be. So it's coming back, it tells you the date, and it gives you a client a risk score right at the top. And why is this important? If for nothing else, you could just save this one page, put it in the client's file, and if you ever get a regulator comes and does an audit, you have the date that you did it, and you've got the risk score as backup. So you're good to go there. The report itself, this should look very familiar. You have green arrow, yellow arrow, and a red arrow. Green is good, essentially. Yellow is cautious. Red is, hey, stop and really look at the feedback because it's a really important issue that you need to work with your client.
Well, but
We've got
green
a
is
little
not
bit about
necessarily green's not necessarily good, right? It's just it may not need to be addressed because good or bad. It's just I don't mean to.
right.
Yeah,
Yeah. No, you're right. It's good and bad's a bad language to use.
yeah,
It is what it is, but it's not like if I don't deal with this today, I'm going to lose this
yeah.
client, right? So you've got a little information here. This should look just exactly like what Charles showed you earlier, where you have red, yellow, and green. So in this particular one, let's look at this behavioral finance item. Your client displays signs of overconfidence. While confidence can be a positive attribute, it's important to help your client strike a balance between confidence and caution to ensure a balanced view of risk and uncertainties. So that feedback is going to be similar in the core product and in the essential product. And if you're a really sophisticated advisor and you've gone through psychology training or you've gone through the badge that Charles and Brad have created, you already know the next steps to deal with this issue of overconfidence and with money scripts. So you're good to go. But if you're like me when I was a financial advisor, psychology was definitely not my background. I was definitely a finance econ major in college, and I thought that's what financial planning was. So if you told me, let's look at money scripts. If you told me, hey, your client indicated feeling guilty about their money, which could lead to overspending, enabling others, and difficulty budgeting, discussing how wealth can be used for good may help address their beliefs. That's really valuable to me as an advisor with no psychology background, but I need more. I mean, honestly, I need, okay, that's good for me to know, but I need more. So I'm going to go down to the bottom here because it's very similar across the domains. Here's their risk score again. And a very basic map. So your client would be comfortable investing in a balanced portfolio. This is a mix of fixed income, cash, and equities. Other clients similar to yours typically invest in equities in the range of 37 to 49%. So a very basic map. It matches probably every other mapping system out there. So, but here's the thing, 90-second client rundown. Remember, I'm that advisor. I have my econ degree. I'm out there advising, but I don't really know a lot about psychology. This is where all of those things that are indicated in red give me more direct feedback on what to do. So it's telling me my client very well may be feeling money guilt, and it gives me very specific things that I can do to work with that client. And like building trust, how do I do that? If they feel lack of control, what do I do? So it's helping me work with my current clients to cement that client advisor relationship. The other thing in this report, you'll notice here under this note, I'm going to highlight it here. We have some algorithms in place to help you as the advisor know whether your client was really serious when they completed the MRI. And in this particular case, we're not seeing any inconsistencies. But if there were inconsistencies, so what might be an inconsistency? Let's say the client said they're very financially stressed, but at the very same time they said they're totally satisfied. That would be an indicator to you that there may be some inconsistency in the way the client answered. In this case, it looks pretty good. There's no inconsistency. So this is an example of the kind of report you would get if you were looking at the essential. And the others are going to be very similar in the look, the ability to customize the logo, the company name, all of that. What did I miss,
Well,
Charles?
well, could you scroll down a little bit back to the arrow? So go back to the 90-second use
Yeah,
case,
let me
right?
go.
I mean,
Yeah.
yeah, you can see how basically especially with the arrows and whatnot, this is easy to read and be ready to go into that client meeting. You're not going to have to take pages and pages of time to read paragraphs to talk about this. It's relevant and it's accessible to read and understand before your next meeting.
I mean, as an academic, would have preferred about 6 pages for every single item, but Charles kept hitting me over the head saying, no, it's if they can't do it in 90 seconds, then it's too long. So that's really our intent here is, you're working with 50 clients over the week or 20 clients or 10, whatever it may be. What are those essential elements that we need to address in the upcoming meetings with this client? Number two, what might be some triggers that are negatively associated with the client's behavior? And with some of these, had I known this 3 weeks ago, a month ago, on January 1st, I might have reallocated my client's portfolio, or I might have taken steps early on to let them know, hey, market volatility is likely, but here's how we're going to deal with it. And so to me, it's what makes this so interesting. The whole MRI platform, it's not just risk tolerance and it's not just psychology. It's the blending of the two into actionable recommendations and tools for an advisor. And at the very minimum, it's a way to create that relationship with the client built on discussions and openness and dialogue. And if nothing else, I think this is what makes MRI so appealing to advisors.
So as we continue on here, uh, so there we go. Oh, whoops, that's not what I wanted to do.
I will
I'll
stop
get it together.
sharing. There we go.
Thank you. There we are.
I'm pretty
Okay.
impressed that we were able to share back and forth without crumpling the whole Zoom session. So
We've
very
done
proud of
okay.
ourselves.
I mean, we've been doing okay. It's getting better as we go. The first time, anyway. So so we're doing all kinds of customization as we talked about. It's been great getting this out and talking with firms, um, and obviously looking as we talked about with product readiness and opportunities to really engage the client and the advisor through nudges. We see this as we're doing a flexible implementation of this as a standalone tool, but also integration, whether it's open API and lots of other opportunities. And then we know that, there's tailored reporting. So, for example, thinking about like working with banks want on the wealth readiness, they want to indicate the closest branch to that client, right? In the report itself. So they're getting some component. The bank is getting another component of the report. They want customization, and obviously branding is important. John was very proud of what he developed in the sample, the sample white label. So we're happy to talk with your firm. We're talking to lots of firms now. We're happy to talk with yours. And so you could schedule a demo and take a look at it. I would say the other thing I would say about it is that we've developed it in a way that we think it's very accessible for all firms financially. We think it's attractive when it comes to what we're charging firms and whatnot, and so we're excited to share that. And I am going to stop the recording. And for the folks that are on, I know we've had several folks